Single family versus multifamily real estate, which asset is better? I started off investing in single family homes, but quickly realized that it wasn't getting me closer to my real estate goals. And then that's when I made the switch over to multifamily. And in this video, I'm going to highlight 5 key differences between single family homes and multifamily so you can make better investing decisions for you. So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. I'm Seth Ferguson. Let's get right into it, talking about multifamily versus single family investing. Difference number 1, and this is a big one. It is valuation. Now, I've done a bunch of videos on the different valuation methods between single family and multifamily before, and I'll put a link right up here to a video I did explaining all about the income approach. And the income approach is how we value multifamily real estate, commercial real estate. And it's all based on the NOI, the cash flow the property produces. Because one thing I always say is, yeah, we're buying real estate when we're buying apartments, but we're really buying a business that just happens to be tied to the real estate. So it's all based on the cash flow, the NOI the property produces. Now, if we go on the flip side with single family is valued based on what's called the comparable approach. So if 3 homes on the same street or in the same area that are relatively the same sell for $500,000, well, guess what? Your home is worth $500,000 no matter what the income that property produces. And this is one of the challenges I found when I was investing in single family homes. Even though you were getting good rents, it didn't translate into the valuation you were getting. The appraisers are just looking at comparables. But with multifamily, we have a lot more control. So if we can acquire an asset and boost up the NOI, so drive those gross rents, optimize or decrease the expenses, so that means we get more NOI, the value of our property goes up. And if we can move that property from being valued at, let's say, a B minus property to a B plus property, that's going to give more value to each dollar of NOI that property produces. So huge advantage with multifamily versus single family when it comes to valuation. Big difference number 2 is financing. Now, anybody who's invested in single family homes like me or residential real estate knows that you have to give an arm and a leg and your firstborn child and maybe half of your secondborn child just to get a loan from the bank. It's incredibly challenging to scale with single family homes, especially financing. The reason is the lender, the bank, is looking at you, the borrower, to shoulder the risk of the loan and to support the loan. So your personal income has to support the debt service of that loan. So, if you're working your 9-to-5 job, whatever that is, or you're full-time in real estate, well, the income you're bringing in every year has to support that debt service. The lender doesn't really care about the income the property produces. They're looking at you first. Now, when we switch over to multifamily, we have a big difference. We're really buying a business, like I said before. So the lender is going to look first at the property. What does the NOI look like? What is the business plan? Can the property support the debt service that you're looking to put on it? All of these questions come to the forefront, and you as a borrower move down the totem pole. Plus, with single family homes, it's very common to have principal and interest payments as opposed to interest only. And I'll put a link right up here to a video I did explaining all about interest only loans and mortgages, because that's a big advantage when we get into larger multifamily properties. So let's say you acquire a property, you're looking at a 10-year note, and maybe for the first 3 years, you're able to negotiate an interest-only period. What does this do? Well, this really frees up some cash flow so you can put money back into the property and improve it, drive your value add plan, and increase the NOI, and in turn, increase the value of the property. That's the entire value add strategy, and having that interest-only payment makes things a little bit easier, and the lenders are willing to work with you on that because they love lending on commercial multifamily properties. With single-family homes, that's not going to come from an A lender. You're going to have to go with private money. That's incredibly expensive and it's so challenging. So when you're acquiring a value add property, when it comes to multifamily, having loan terms that are more favorable definitely help. And then there's recourse versus non-recourse debt. I'll put a link to that video right up here as well. And basically what that means is with recourse, the bank can come after you personally and basically take all your assets if you default on the loan and you cause them loss. That happens 99% of the time in single family home investing. So you're shouldering a lot of the risk. Multifamily, you can get non-recourse loans, which means the bank, the lender can seize the property, take control of the property, but they can't come up after your personal assets. So you're basically alleviating a whole lot of stress off your shoulders when you get into the multifamily space. So that is a huge advantage for multifamily. For number 3, I touched on it a little bit, and it's scalability. I'm not even sure if scalability is a real word, but we'll just go with it for today. So like I teased with my second answer, it was incredibly challenging to scale to any decent size with a single family portfolio. A number of reasons for that. Well, number 1, we have the financing. You're basically hitting a brick wall with your head over and over again, doing everything you can to get approved for the next loan, because residential financing isn't really geared towards scaling a portfolio. And then also you have, let's say you want to own 10 single family homes. Well, that's 10 different tax bills, 10 different locations, 10 different roofs or roofs. But with multifamily, you can take down a 50 unit building, a 75 unit building, 150 unit building, and everything is concentrated in one location. So it just makes scaling a whole lot easier, and it's a whole lot easier to manage, which kind of brings me into number 4. So this could almost be like 3 and 3.5, but we'll call it number 4 because I did promise you 5 differences. So difference number 4 would be management. And management is incredibly different between single family and multifamily. Well, number 1, single family home property management is incredibly expensive. You're looking at paying 10 to 12% of your gross rents pretty much across the board to manage your single family home. And here's the thing, the property manager will come by maybe once a month, once every 2 months, or whenever there's an issue. You don't really have constant hands or eyes on your property. So when we look at multifamily real estate, especially with the larger properties, you have full-time staff there all the time. You have full-time maintenance. You have full-time leasing agents there. And guess what? Who do you think is going to take a better care or do a better job or have a better handle on your property? The people who are there every single day, who build a relationship on a daily basis with your tenants, or with your single family home property manager, who may be a great property manager, but they're just managing a much bigger portfolio. When I'm comparing the two, management, well, you're a lot more expensive and you don't have as many touches on the property. With multifamily, you have full-time staff. The property supports it. You have a payroll for the property. I just really, truly believe you get a better product and you can get on top of those problem issues or those issues that come up and nip them in the bud before they even turn into a much larger issue, because your people are there all the time. Plus the cost of managing a multifamily property, and this kind of goes back to scaling. Your management cost is spread over 150 units or 100 units rather than a duplex. So it just makes things a whole lot more scalable. And management wise, you're looking at one property, you're focusing on that one property, managing your 100 units, 75 units, whatever it is, as opposed to 10 scattered properties, 20 scattered properties throughout, the same city or the same state or province, or even across the country. Who knows where your portfolio is. And the 5th difference, last but not least, and this is incredibly, actually all these are important, but this one is especially important if you're looking to scale and grow bigger, and that is raising capital. Big differences in how we can go about doing it because of the scale, because of the size, and because of the type of properties we are acquiring. So if you're investing in single family homes and you want to scale, and this is what a lot of investors do when they hit that financing brick wall and they're trying to bust through it, but they just can't get any more loans from the bank because they're tapped out. So this is what a lot of people do. They'll go out and acquire a partner, a joint venture partner, and they'll have that partner sign on the loan, maybe front the equity required, and they'll find the deal, they'll manage the deal, they'll be more day-to-day. And they create a partnership, a 2-person partnership in this case, to take down the deal. Now, here's the misconception. A lot of people will think, oh, if I'm just signing on the loan, if I'm just bringing my equity, investing capital into the deal, and the other person's doing the hands-on stuff, well, I'm passively investing. I'm a passive investor. This couldn't be further from the truth, because if the deal goes belly up, well, guess what? The lender and all the creditors are coming after you both equally, because under the eyes of the law, you are both incredibly active in the deal. So when we're raising capital for single family homes, we can't really take advantage of more sophisticated structuring because the size of the deal doesn't make sense. Like, it's cost prohibitive at that point. But when we get into multifamily, we can take advantage of some sophisticated structuring like syndications and funds. With the syndication, we basically have a general partner, the team that actually runs the deal that's active, and then we have a limited partnership. These are the passive investors. Now, the big difference is these are true passive investors. It's actually structured into the syndication. So they're investing their capital, they're not doing anything else, and they're actually protected if something goes wrong because they are a true passive investor. So if you're really looking to scale and raise a whole lot of money, well, look at Wall Street. Wall Street does one thing really, really well, and it's raise and deploy large amounts of capital. And syndication is the structure Wall Street uses to raise that capital and deploy it. We're just going to take things a little bit differently and deploy it into multifamily real estate investments rather than whatever Wall Street does, and then they sell you the stocks for it. So with raising capital, it's a whole lot more efficient. It's a whole lot more scalable. You're offering better protections to your investors by raising capital through the more sophisticated structures like a syndication with multifamily versus a single family, which is a one-on-one basis, and you're doing individual partnerships. Now, I'm going to give you one bonus. And this is a multifamily real estate channel, but let me give you a bonus if you are investing in single family homes and you are raising capital through joint ventures. You have to be incredibly, incredibly careful that you are not using cookie cutter agreements to bring in joint venture partners for each of your deals, because you could be found to be really trying to syndicate or trade in equities at that point. Because if you're just bringing a whole bunch of people in, let's say 4 different people into the deal, and they're all cookie cutter agreements, and you're really raising capital, and you could fall on the wrong side of the securities, governing bodies, depending on if you're in Canada with the provincial levels, and then in the US with the federal level. So you have to be incredibly, incredibly careful if you are doing joint ventures with single family homes and you are raising capital from a number of people for one deal. You have to be so, so careful that you can't be misconstrued or be seen from the SEC or whoever it is as raising capital from investors that way, because you could get into a whole lot of trouble. So that's a little bonus tip right now for raising capital for single family homes. But like I said, with multifamily, you can raise a whole lot more, deploy it more efficiently, and you can actually give your investors a better investment. And I'll put a link right up here to a video I did explaining all about the syndication structure and all the other things you can add into it, like waterfalls, hurdles, preferred returns, and how you can customize it to suit your specific deal. Now, if you are interested in learning more about multifamily real estate, I want to invite you to the Multifamily Conference coming up May 14th and 15th, 2022 in Toronto. We've got a whole bunch of speakers, Kevin O'Leary, Joe Fairless, Joel Block. Check out the full list at multifamilyconference.ca. Super excited to have all these high-level, top-notch speakers coming to give you guys the details on multifamily real estate investing. And if you like this video, if you found this useful, hit the like button, leave a comment, let me know what you think, and until next time, happy investing.